would be some changing in the format of the information. It involves a comparison of statement of two or more periods or maybe enterprises. So it can be happened in any way. Maybe it compares only 2 years of the same company data, or maybe 1 year data of two companies, and then they analyze the particular system. Tools can be used for horizontal analysis are trend statements, common size statements, or maybe more enterprises statements according to the requirement of periods. Comparison of 2 or more years financial data is known as horizontal analysis or a trend analysis. That means the very simple definition of horizontal analysis is simply 2 years data has been compared, that is called horizontal analysis. It is facilitated by the showing changes between years in both, either maybe in rupees or in percentage form. That means, as I already mentioned, sometimes the data has been changed in the different format, and then they find out the comparisons, and comparisons can give a results of your arguments. So here it can be changed maybe according to the requirement of rupees, or maybe it would be converted into percentage format. Showing changes in rupees from helps the analyst focus on key factors that have affected profitability of a financial position. Ultimately, this is a dynamic analysis. On a horizontal analysis has been provided various type of solutions, and that is why it's a dynamic analysis. Moving to the next types of analysis, that is vertical analysis. It refers to the relation of each information with the total quantum data within a single statement. It means that the whole data has been actually written down in the one statement itself only, and that data has been represented with a simple format. In case of that, if you have an income statement, then the sales would be a base concern, and it would be assumed that the today's sales is 100. On the basis of that 100, we will compare all other information of the income statements with the sales. That means suppose the labor cost is 20 and the sales is 100, we would represent that the labor is 20% of the sales. So it consider in this particular way. Example is very clear. So it makes use of common size statement 2 for financial analysis. As vertical analysis is restricted to a single statement, it assumes significance only that the comparative analysis or when common comparative size analysis statements are necessary to be prepared. Similarly, calculations of ratios from financial statements of a single accounting year is a part of vertical analysis. That means if you are going to calculate a ratio for 1 year, it is simply a vertical analysis. But if you are going to calculate the ratio for a number of years or for a different of years, it could not be considered a vertical analysis. That is horizontal analysis. Key financial changes and trends can be highlighted by the use of common size statement. That means the trend has been designed, changes has been identified, and these particular things can be considered a common size statement analysis. Vertical analysis is the study of quantitative relation existing among the items as a particular point of time. That means it's a quantitative relations, and that quantitative relations is among the different items which you are taken at that point of time for the analysis. It justifies the contention that the vertical analysis is a static analysis. That means the horizontal analysis was a part of dynamic analysis, and this is a static analysis. Here, now we are moving for the next important point, that is the techniques of financial analysis. There are 6 techniques. Here the first is comparative financial statement, then the common size financial statement, then third is trend percentage, fourth is fund flow and cash flow analysis, then the fifth is ratio analysis, and the sixth is CVP analysis, which is cost, volume, profit analysis. So the 6 techniques are there. Now start with this first technique, that is comparative financial statement. The name itself suggests that the financial statements are supplied in such a way that they are comparable. So if the profit and loss account is given, but it is given only for 1 year, it cannot be compared with anyone. Whether you are not having information for the second year or it is not available for the another enterprise's profit and loss account also can be compared. So intra or inter, both are not possible in that case. So that's why if you are providing a 2 years informations or maybe two enterprises informations, it would be easily compared. Here the figures of 2 or more periods are placed together in such a way that it simplifies a comparison. So the 2 years informations would be very much easy to compare each other. Example, if the sales is given for the last year and the current year, both the year sales together, it can be easily compared and can visualize also whether the last year sales is higher or the current year sales is higher. Or maybe if you are going to take a base year, then it will be find out in percentage, and through the trend you can identify through the percentage which year sales has been increased, how much percent as compared to another year also. These are designed by keeping in view the perspective of time. Profit and loss account and balance sheet can both be presented in this format and get benefit of the comparative study. In that, the two things are important. One is comparative income statement. Let's begin with the comparative income statements. It shows revenues and expenditure of 2 or more periods. That means, suppose if you are going to compare only with the past year data, then the 2 year important informations regarding the revenues and expenditures are compared. When these amounts are placed together, one can notice the change that has taken place over a period of time. As I already mentioned earlier, that easily compared when the 2 years data are together, and it is visualized that which year the data has been changed or improved or maybe required to change it. Here one can take also help the ratios to know the effect of the changes that can taken place. This is a part of first thing. Now the second is comparative balance sheet. A single balance sheet will represent the current financial positions of the business. So single balance sheet is represented only at the particular point of time what is your status and what amount of informations are available at that particular day. But when you want to compare, then the 2 or more balance sheets are required, and that organization has to be provide 2 years balance sheet, 2 consecutive years balance sheet will come to know whether the position has been improved or it is worst. So that means the 2 comparative years balance sheet has been given the information that the amount of information through company's status and company's financial strength. It helps in forecasting trend for future as well. After comparing 2 balance sheets, management come to know about capital has changed or not, liabilities are increased or decreased, or whether fixed assets are required more or not. Next is common size financial statement. Common size financial statements are those in which data reported are converted into percentage to some common base. So that means the common size statement has been compared. Before that, it is necessary to convert the data in a specific format. So the specific format is nothing other than that is only a ratio or in a percentage. So if you converted your data into percentage, and when you converted the data in percentage, certain things are considered as a base. In simple terms, common size financial statements when read do not give any information about the trend or details of individual items, but it depicts the relationship of item as a whole. That means which particular item is actually considered as a base. That base item should be considered that which is related to the all other items, or which have a relations or which can be affect to all other items, like a sales. In revenue statement, the sales can be connected with each and every other items. So in that case, I'll take a base item is sales. So sales would be 100, and as compared to this 100, all other items percentage would be designed. Every item recorded is defined and interest as a percentage of some base, and thus the relation is known between the items has been presented. Next method is trend percentage. It is a beautiful technique designed when the company wants to make a comparative study of the financial statement for various years. Why it is a beautiful item and reasonable system methods? Because of this is very easy to compare and easy to understand by the layman for different years. In here, any year is taken as a base, and then every item of subsequent years financial statement is presented in the form of percentage. That means any particular 1 year is taken as a base year, and all the other informations, subsequent years informations, has been converted into a percentage, and then that percentage has been compared. So automatically it reveals in a trend format which particular period your data has been violated or you are not up to a mark, whether it is an increase or it is in a decrease situation. Few observations to be kept in mind before executing this technique. The methods, procedures, principles, etc. of the accounting has to be similar or constant throughout the period. That means that should not be breaking. Whatever the methods are applied, that methods has to be followed continuously. Procedures, which way you wanted to find out the solutions and analyze the system, that procedure is also not to be interrupted, it is continuous. And principles, the standards which you are designed cannot be changed and break during the activity has run. Selection of the base year is an important task. So when you selected a base year, the base year is actually not biased. Not biased means it should not be selected the year which was affected by any abnormal situation, maybe strike, maybe any specific reason due to flood or fire or any other reason, if the business was shut down for some period of time which was not a normal year. So their data may be not a normal year data. So that year should not be selected as a base year. When the percentage are put, one should be able to derive some meaningful conclusion out of it. So when you find out the percentage, there should be some meaningful conclusion out of that particular argument. And the current trends of the pricing level, volume and the margin should be taken into consideration while calculating a trend percentage. This is the third method. Now moving ahead, for the next method is fund flow and cash flow analysis. Fund flow, it means all about the changes of fund, whether it is changed through the working capital or maybe any other way. If it affects to fund, it would be a fund flow. Or cash flow, it means that whatever the changes are occurred in the cash during the year as per the comparative transactions, that is affected to a cash flow analysis. A fund flow analysis is known also as a fund statement, statement of sources and application of fund, where got, where gone statement. So these are the other names of these particular statements. Irrespective of the name by which a fund flow statement may be called, an effort is generally made to report to flow of funds, that is increase or decrease. That means according to the comparisons and according to the transactions, it may be find out or report can be identified whether it is increase or decrease during the period of between 2 points of time. Here I want to mention, when you are going to apply this analysis, you need to have an information of 2 consecutive years data. That means the last year and current year. If you have a 2 consecutive years data, then this particular technique or method can be applied. Also assess its impact on the working capital portion. How the working capital has been designed and what are the changes to be happened in working capital. For that, the company has to prepare a separate statement to show the changes of working capital, and it reveals that the changes in working capital through the fund flow analysis. So here the fund flow and cash flow analysis, that the changes of a part of concern. Now moving to the next method, that is CVP analysis, cost volume profit. Now there are three words, but all these three words are interconnected. How? Cost is actually raised according to the amount of expenditures incurred. Maybe labor cost, maybe material cost. It depends on the changing of volume. That means if you are manufacturing number of units X and then you increase X plus 1, automatically it reflects on your cost. So the cost and volume, and if the cost is changed according to the volume, it maybe reflects on your profit also, because of you increase the number of units, then you maybe increase your sales also, and if you increase your sales, it would be affected to your profit volume also. So CVP analysis is all about the excellent tool invented to know the exact profit standing and help the organization in planning the profit for future period of time. It basically explains the relation between cost incurred, volume of output and production for the particular concern. So how much amount of sales, what amount of profit, the production moments, outcome moments, everything you can understood and getting an idea through the cost volume profit analysis, that is CVP analysis. Basically, it helps the management in taking various important decisions as a controlling of cost. It also helps the manager to know at what level of sales does the organization start earning the profit. So that means the company will need to know that many times from particular which level it starts the profitability. That means break-even point. So from that break-even point, the company will identify what is their total cost and how much their sales revenue has been raised. Ultimately, it displays the effect on profit due to variations in production, selling price and cost. Moving to the next and last method, that is ratio analysis. The ratios are used as a benchmark to evaluate the financial condition and performance of the business. Ultimately, ratio analysis is a comparative analytical statement of two financial and statistical or mathematical data, nothing other than that. The extensive analysis and elucidation of various ratios provides an excellent analysis and picture to analysis regarding the financial condition and performance of the business. That is, the ratio analysis ultimately reflect on your position, your condition, and how the improvisation can be done. The solution also can be done and given from the ratio analysis. The term ratio basically means an expression of one article or maybe one item with another in some mathematical form. No purpose will be served by comparing two sets of variables which are not at all connected with each other, so that it must be connected in some manner. So if it is not connected each other, they may not be compared. Ratio analysis can be happened only if the two factors and two items are interrelated and there is some possible outcomes which would be helpful to improvise your decision making. The ratio analysis can be done. Yes, the next point is a limitations of financial statement. This is the last point of this particular chapter. Here there are many limitations, and as we are